It'd be a real blunder to talk about FX trading, or trading in general, without touching on the topic of candlestick patterns, period. There's a ton of hype around them. Some say they can predict future price movements, while others think they're just hokum. This video isn't here to sell you on either side. Like any tool, candlestick patterns have their advantages and limitations, and it's essential for traders to understand both. But let's get one thing straight. Candlestick patterns won't and can't give you the full story or magically map out future price movements. What they can do is add confluence to your analysis. How much weight you put on them is up to you. At the end of the day, every trader has to tweak their strategy and figure out what works best. First things first, what exactly is a candlestick? The most common type of candlestick traders use today is the Japanese candlestick. And for good reason. A Japanese candlestick visually represents price movement over a specific time frame. It's important to note that it shows price movement, not necessarily price action, but we'll get into that later. Each candlestick can represent any time frame you choose: 5 minutes, 15 minutes, an hour, or even a full day. A candlestick has two main parts, the body and the wick, if present. The key details packed into a single candlestick include OHLC, open price, high price, low price, and close price. The overall price direction within that time frame, whether the price moved up or down. If the price increased, the candle is usually green. If it dropped, it's typically red. What a candlestick does tell you. Primarily, a candlestick provides 5 key data points, 4 price levels: open, high, low, and close, OHLC. Price direction within the chosen time frame, whether it moved up or down. Many traders believe that a candlestick shape can reveal market sentiment. While there's some truth to that, it's far from a crystal ball that predicts exactly where the market will head next. For now, let's focus on what we know for sure. A candlestick generally takes on 5 main shapes, each with bullish and bearish variations. Normal candlestick has a regular length body with 2 wicks. It mainly signals whether sentiment is bullish or bearish, but doesn't reveal much beyond that. Marubozu candlestick has a long body with no wicks, or very short wicks, indicating strong momentum in one direction. Doji candlestick has a small or non-existent body, suggesting indecision or market equilibrium. Spinning top candlestick features a small body with long upper and lower wicks, signaling uncertainty and potential volatility. Hammer candlestick has a small body with a long lower wick and little to no upper wick, typically indicating a potential reversal after a downtrend. How does a candlestick shape reflect market sentiment? Let's take the hammer candlestick as an example, as it's usually an important part of various reversal patterns that traders love to use. Now is a good time to note that a candlestick in a high time frame is the combination of multiple lower time frame candlesticks. The rationale behind the hammer candlestick is like this. Initially, sellers dominate and push the price down. Then buyers step in aggressively, absorbing the selling pressure and driving the price back up, sometimes even above its opening level. This signals a potential takeover by the bulls. But is that really the case? It could be interpreted very differently depending on the order of events. In this illustration, we can see that the bulls have not necessarily won, and the tug of war is still ongoing. The only thing we can be sure of is that the long wick represents a strong turnaround in the market. However, that brief glimpse of market sentiment cannot tell you with certainty what the next candles will do. That's why traders usually look for extra confirmations alongside the hammer candlestick, such as a strong bullish candle closing above the hammer, increased trading volume on the hammer or following candle, the hammer appearing at key support levels. Bottom line is candlestick patterns are best used as confluence factors rather than the sole basis of a trading strategy. What a candlestick doesn't tell you, as explained earlier with the hammer candlestick example, a candlestick, or even multiple candlesticks, can't tell you the full picture of price action. There's only so much information that can be packed into a Japanese candlestick. Trading usually requires more than just that limited bit of data to gain an edge in the market. For example, a candlestick can't tell you the actual movement of order flow. Unlike an order flow candlestick, which reveals the number of market orders being executed in real time, giving deeper insight into market sentiment. A standard candlestick lacks this level of detail. A lot happens while a candle is forming. Trading volume fluctuates over time. Price areas with the most trading activity become evident. Key price levels where the highest volume was traded emerge. Japanese candlesticks alone can't tell you all of this. As emphasized earlier, this video is not here to debunk the use of candlestick patterns in trading. In fact, many traders use these patterns and still manage to find an edge for themselves. But candlestick patterns are best used as confluence factors, not the sole foundation of a trading strategy. Try to build your edge around them, but don't get too dependent on candlestick patterns if possible. If you found this video helpful, hit that like button, subscribe, and drop any questions in the comments below. Thanks for watching and happy trading.